We've talked about how Indian stocks have gone from very expensive to very cheap, but even then, the Sensex trades at 2 times book value, which is more expensive than the stocks in Southeast Asia, for instance. Is there any compelling reason to be in the Indian market?
So I think the price to book has to be put into the context of the sustainable ROE. And what we've seen is through the cycles over the past 25 years, Indian companies tend to have a higher return on equity than their Asian brethren. So I think you need to put that into context. Also, what we have seen is when the price to book dips below 2, and we have evaluated this across various bear markets, like the global financial crisis, like the tech bubble burst, like what happened in the Asian financial crisis. 2 is a good number. It's a pretty sacrosanct number, actually. If you look at the MSCI India Index, it's now trading at 1.7 times book, which is the lowest level it has ever traded in its history. It has gone through the levels of the Asian financial crisis. So when you look at these levels, the prospective returns from here tend to be pretty strong with a 1 to 2 year view. So notwithstanding the volatility that I think we will continue to experience over the next few weeks, I think people who have the stomach to digest that will probably come out with pretty strong returns in a year or two from now.
Having said that, Rhythm, how much of the risks are already reflected in current prices? I mean, we're already talking about the potential of a recession. We've talked about how, Prime Minister Narendra Modi has come in a little too late. How much of those risks have been factored in?
So I think right now, this is my gut feel. It is very little precise science behind this, but I think the market is probably pricing in, kind of the economy coming back to some state of operation in the month of June. So, we don't get a lingering effect of the shutdown, and we come out of the shutdown middle of April, and then we slowly crawl back to normalcy or near normalcy. I would say a little below normalcy in June. So we kind of lose about 1 quarter of GDP in India, 1 quarter of earnings. So to that extent, we have actually cut our F21 estimate, so the Indian financial year, which ends in March, which, by the way, was extended yesterday by 3 months. So we're not adjusted for that. But for the next 12 months, we have cut the EPS by about 20%, and that makes this assumption. If these things worsen from here, and if for some reason the virus actually starts flaring up in India, then of course we'll have to revisit that. So that's what I think may be priced in. But again, it's very hard to make that judgment. The global recession call, I think, is material because India does have 20% of its GDP from gross exports. And to the extent that things are looking a little unsettled elsewhere is also of importance to India.
Rhythm, are you actually making any forecasts for levels on the benchmarks now? Because you take a look at the median target for the Sensex. That's at 44,500, which is basically 50% away from current levels. Are markets really going to rally that much?
No, I don't think the street may have updated the numbers. We have been updating them. We've been ferociously updating them. So right now, my year-end Sensex target is about 32,000. Which is a far more modest upside. And it's actually not out of sync with what my global strategists in the U.S. and elsewhere are saying, which is a lot of them are opining that the market may have done its worst. That doesn't mean we enter into a V-shaped recovery, but we may not necessarily break through the bottoms that we saw last week. And I think that holds for India as well. So unless we get really terrible data on the virus, I think that 7,500 handle on the Nifty is a pretty good level for us to consider as a bear market bottom. Again, as I said, it will primarily depend on the quantum of the fiscal response and where the virus heads, but that's our current view. At least the indicators that we track, both in India and elsewhere, are suggesting that markets did put in a bottom in the last few days. And are now probably looking to retest them, but we may not break through those levels immediately.
Rhythm, we had SEBI, the Securities and Exchange Board of India, relaxing default rules, also delays in obligations. I'm just wondering, is that enough or more measures are needed?
See, so from a regulator's perspective, I think what SEBI and RBI have done, I think is very good. And a lot of it has exceeded our expectations. They've acted more swiftly than in the past. And I think they have the comfort of India's macro stability to rely on, which is also a lot better than it used to be. The government, as I said, has still more to do. So the efficacy of all this really depends on how large the fiscal stimulus is. And so I'm hoping and expecting this to happen over the next couple of days or maybe by the end of this week. And that will then, I think, give a push and it will, add to all the work that SEBI and RBI are doing.
And Rhythm, before we let you go, how's your allocation going now? I mean, are there certain sectors that you're looking at that are perhaps a little bit more resilient to the pandemic as well as these nationwide lockdowns? And are you looking to add to those positions now? And what would you be avoiding?
So we actually added to financials at the last Tuesday morning, very luckily. Financials rallied from there and now have started correcting. My view is that financials have borne the brunt of this fall, rightly so, because if you look at what hurts the most, it's financials. It's when, business loans start defaulting. Financials suffer more permanent loss than other sectors. And therefore, the market has singled out financials for punishment. We thought a good opportunity emerged, and I think financials are looking very attractive, including, in fact, more, if I may emphasize, the high-quality private sector banks, which all this while were trading at rich valuations, and investors kept complaining about how rich they were. They have all now turned into very reasonable and attractive valuations. So that's one sector that we have bought. We also actually went overweight energy because, oil prices where they are actually benefits most of India's energy sector. We actually funded this by increased our underweight position in technology. Now, for now, technology is actually outperforming because it's defensive. But I think if we come out of this in the next couple of months, then I think technology may underperform. It may not have the same sensitivities to domestic growth as some domestic cyclicals will have. We are already overweight consumer discretionary. We're not touching that. Auto stocks particularly look very attractive, including the two-wheelers and the four-wheeler companies.